Alright, so this is a re-recording. For anyone that was at the live stream on 2-4, you may have already seen this, but if you didn't, well, here it is. For some reason, YouTube only saved about the first 6 minutes of the live recording, so I'm re-recording it for anyone who wants to take a look at the lesson. And yeah, so to kick it off, we went over risk reward ratio today. Basically, it's a way that investors can correctly determine how much their reward is versus their risk. A lot of people use risk reward in the wrong way, right? They just they set their take profit higher if their risk reward isn't correct, and it's supposed to be the other way around. So for example, if say someone has their stop loss at 20%, then they'll just adjust their reward to 40%. That way their risk ratio is 1 to 2. And that's the very incorrect way of using it. Um, it's supposed to be the other way around. So you're supposed to determine how much value you think is in the investment or where you want your take profit to be, and then you set your risk or where you want to stop and determine that based on um, or take that to determine your risk ratio based on those two. So it's very important that you do it correctly because it's one of the things that when used correctly, it can literally turn yourself around, right? Risk reward ratio was one of the big things that made it so I can get those portfolios that are up 2,000% in insane numbers like that. It's mainly because I'm very strict with my risk reward ratio. I'm well aware of the biases in trading and work every day at preventing those biases. And then lastly, my strategies all are very strict with the strategies themselves. They're not strict in the criteria, right? They're not like I don't look for very specific stocks, right? Like sometimes I may be investing if I'm looking for let's just say a undervalued stock, right? I'm not looking for specific ratios or specific free cash flow. I'm valuing the company as a whole from its standpoint and compared to its competition, market value, and all these other things. So my strategies are strict in that I'm looking for very specific companies that have certain advantages, right? But they're not strict as in every company needs to stick to a specific criteria. So, with that considered, risk ratio, it's basically the way you can determine an investment and if the risk is worth taking. So, consider the following example: an investment with a risk reward ratio of 1 to 7 suggests that the investor is willing to risk $1 for the prospect of earning $7. Alternatively, a risk reward ratio of 1 to 3 signals that the investor should expect to invest $1 for the prospect of earning $3 on their investment. Okay, so this is something that I think a lot of people, most people understand when it comes to risk reward ratio, right? I mean, it pretty much the ratio determines for every $1 you're risking, you're earning this much. All right. Traders often use this approach to plan which trades to take. The ratio is calculated by dividing the amount of trader stands to lose if the price of an asset moves in an unexpected direction, the risk, by the amount of profit the trader expects to have made when the position is closed, the reward. Okay, so this is what I was talking about before. A lot of people will just sit here and they'll say, well, if I want my risk reward ratio to be, let's just say 1 to 5. I'll put my reward at 50% and I'll put my risk at 10%, and then boom, I have a risk reward ratio of 1 to 5. And while that is technically true, you are applying it very wrongly, right? You want to determine the value first, and based on the value that you think it is worth and where you think you will be closing your position, determine the risk. Okay? And that's where I think a lot of people mess up, because this is supposed to basically be a tool to tell you if you should take the trade. Okay? So for example, for me, for stocks, I usually don't take a trade unless I'm expecting a risk ratio of 1 to 10, right? So for individual stocks, I'm looking for 1 to 10. For option plays, I know many of you have probably seen my option plays, but for option plays, I'm looking at least for 1 to 50. And if I'm just adjusting the stop loss and take profit to get that 1 to 50 or that 1 to 10, then it's pretty much pointless. But if I'm actually valuing the plan, looking at the setup, and then determining based on the value I think it has the risk, and I see and it's only a 1 to 3, right? Or if I'm looking at an option play and I see it's only like a 1 to 20, then I know it's not worth the move, right? And this is a good way to minimize risk. That I feel like this is one of the biggest reasons why most people, no matter what asset you're trading, usually fail in the long term, right? You'll have one move that soars, goes like 500% up, and then all your other moves end up going down 10, 20, 30, 50, 100%. And this is why, is because you're not using risk reward ratio. If you were, then all those ones that went down, you wouldn't have even taken. And the one that soared up 500%, 1,000%, that would have been the only move you took. So, when used correctly, it really narrows down the, well, risk you're taking, right? That's the whole point of it. So, um, in many cases, market strategists find the ideal risk to ratio for their investments to approximately be 1 to 3, or 3 units of expected return for every 1 unit of additional risk. Investors can manage risk reward more directly through use of stop loss orders and derivatives such as put options. So I wouldn't worry about put options unless you are rolling in the bank, right? You got like $1 million portfolio, definitely, because most moves you're going to be making are going to be in the tens of thousands, hundreds of thousands into one stock, right? That case, use put options. But unless you have this insane sized portfolio, I would suggest staying away from put options and just focus on your stop loss orders. The risk reward ratio is often used as a measure when trading individual stocks. The optimal risk reward ratio differs widely among various trading strategies. Some trial and error methods are usually required to determine which ratio is best for a given trading strategy, and many investors have a pre specified risk ratio for their investments. Note that the risk return ratio can be computed as one's personal risk tolerance on an investment, or the objective calculations of an investment's risk return profile. In the latter case, expected return is used in the denominator and potential loss in the numerator. Expected return can be computed in several ways, including projected historical returns into the future, estimating the weighted probabilities of future outcomes, or using the model like the capital asset pricing model. To estimate the potential loss, investors may use a variety of methods, such as analyzing historical price data with technical analysis, using the historical standard deviation of price action, or assessing company financial statements with fundamental analysis in models like value at risk. These methods can help investors identify factors that would impact the investment's value and estimate the potential downside. So, for my technical analysis folks out there's a great example of how you can use risk reward ratio properly. A lot of people will basically they'll like I said before, when they're doing technical analysis, they'll usually just adjust their stop loss or their take profit and say, oh, well, before I had it at 30% and 10%, and I just adjusted the take profit to 50%, so now my risk reward ratio is better. And that's not even how you do it, even if you are using technical analysis. For my fundamental analysis folks out there, I hope you already know this stuff, but even if you don't, here's a great example of some things that you can do. Me personally, I already have this set up in Google Sheets. I know, pretty wild, but it's one of the things I look at in my Google Sheets I have up here. I have a couple sheets. Some people like Cheesy and them folks, Fulcrum, have already seen my sheets, and but yeah, it's one of the things I run every stock through using different models and determining its risk ratio. So keep that in mind. Like I said, risk ratio is one of the very first things I look for at an investment, and if it doesn't match the risk reward ratio, then it's like that is the one thing I'm actually strict on. Where some people sit there and look for a specific ratio with like PE or book value per share or any of those, that I I could care less about those, right? I'm looking for a good risk reward ratio. As long as this ratio is good, then we can look at all those other ratios. Because sometimes companies, like if you look at the PE ratio of Apple, looks phenomenal. If you look at the PE ratio of a company like Amazon, it looks like dirt. Especially if you looked at Amazon back when it was starting out. Whew, terrible. The company looked terrible. Bezos was drowning in debt. And now look at Amazon, right? So you gotta evaluate a company based on the market it's in and its competitors and all these other things, right? I feel like risk reward ratio is the one ratio you can look at and actually determine a company based on that ratio alone. Any other ratio, there's multiple factors that determine if it's good or bad. Um, so yeah, uh, that's pretty much it. Risk return ratio is potential loss divided by potential gain. So there's the formula for it. But yeah, risk ratio, definitely keep it in mind. Um, I feel like the best investors are the ones that have the best skills with risk reward ratio. Like it really can be that determining factor. You could suck at valuing companies, but if you're good at risk reward ratio, you'll still come out on top every single time. So definitely keep it in mind, and it's worth something practicing. If you aren't already using it, definitely use it. Um, so for the market, we got the Buffett indicator. Still pretty high from that little dip we had in October, right? We had that little dip. There it is. That little dip in October, and yeah, October it kind of just went sideways. It didn't really do anything. So, yeah, came down from what was that? November, came down, whittled away in October, and then it's kind of started bouncing back up this year, which is expected. All these companies having their earnings coming out and everything, it's kind of expected. Catalyst monthly sales announcement for January of 2024. All right, so that'll be taking place, right? Definitely worth keeping an eye on. January sales results. This is definitely worth taking place. I'm not sure why they aren't filling the info in on here. But anyways, yeah. Let's go to this one. This one's a lot better. So anyways, consumer credit panel, trade balance, wholesale trades. Those are the three I'd mainly stick to out of all of these. A lot of these other ones don't make that big. They don't get me wrong, they still determine the market pretty big, but those main three I definitely pay attention to. Those are going to have lots of determinations on the market. And for those people who don't know, a lot of people ask why pay attention to market events. Market events determine the movement of the market. That's why they're called market events, right? A lot of people think it's earnings that make a big difference, and it earnings do make a difference, but they take a backseat to market events. Best example I have is last earnings for Nvidia. Nvidia crashed despite its revenue being up by like 500% and it crushing EPS. The stock crashed. The damn near the entire market crashed. The reason why was because there was a market event, I believe it was in real estate, that did absolutely terrible, and the entire market took a dump. So keep in mind these market events, because when you do, once you figure out how to determine market events and when not to trade, then you can use those market events to make the really big trades, right? You guys see my option trades and they're up like 3,000%, 5,000%. That's how market events. These market events are big. All right. Fear and greed index. So it's down from last week. We're seeing a dip here. I don't think it's going to come down into the neutral zone. I think we're still going to bounce around greed for a while. Um, yeah, last time we were that low was back in November. November, October-ish. So yeah, last time it was that low was from September to November. We kind of had a dip there, and that kind of makes sense, right? When we look at oh boy, when we look at over here, right? We see September dipped all the way down in November and then came back out. So it makes sense, right? Market was pretty overvalued. A lot of people selling out. That's when the fear took place, and then it came back up. So definitely worth keeping. Keep that in mind. Less people are buying, but we're still in the greedy zone. So still lots of people buying, just some people pulling back. So worth keeping in mind. Index or the momentum index we have here, or sorry, not index, ETF, the momentum ETF we have here. We saw a bit of a dip those couple of days right there, 31st through the 1st, but overall it came up 2.33%. We're still doing good for the month, right? We've been climbing all month, and it makes sense. All these big companies coming out with their earnings and everything. It's a good start to the year. Definitely a good start to the year. So yeah, we're seeing that happening. Mergers. We saw Sony Group. Oh, Sony Group terminated the merger, so it's not even that one. But yeah, there's not really that many mergers going on since we last looked at it. Not too many big companies in here. I mean, they're obviously big mergers, but unless you're invested in these specific companies, there's not really anything big happening here, right? So, yeah, there's that. Insider buys. So, I just want to make sure everyone's aware of this now that I've started going over insider buys every week. Keep in mind, just because there is an insider buy and it's huge, that does not mean to buy into it. Okay, please, however you feel comfortable, evaluate the company first. All right, I don't want to tell people how to evaluate the company, but keep in mind that even insiders make mistakes, and they could just be averaging down on a position, right? They do the same tactics, okay? A president might already own $5 million in shares and just bought another million to average down his price. Okay, it doesn't mean that the company is all of a sudden going to soar. It could mean something is coming up, but that's another lesson for another day. Maybe I'll go over that. But yeah. Also keep in mind, filing date and trade date, two totally different things. So we'll see here they filed the date 0202. Okay, so on February 2nd was when they announced it. They took the trade on 11/22. Okay, So just because it's being announced publicly does not mean to go and buy it, because for all we know, the company could be way higher than their buy price. And then you're the one holding the bag while they're making the gains. So keep that in mind too. Lots lots to consider. But anyways, since we last looked at it, Rocky Mountain Chocolate Factory, which you could probably guess is candy and chocolates. 8 insiders have purchased a total of 2 million or 280,000 shares, totaling to 2 million total shares owned. Their ownership is up 15%, valued at a little over $1 million. So definitely something to keep in mind. Could be a little something happening there. Like I said, however you feel comfortable, evaluate the company first, but it's a huge insider trade. Pretty big insider trade. So definitely worth keeping an eye on. Um, and then for the coming week, we have lots of companies coming out. We got everything from Disney to McDonald's to all sorts of different companies. I don't know why I can't think of the other one I was looking at earlier. Eli Lilly. But yeah, lots of companies coming out with earnings this week. So for Monday on the 5th, we have PLTR and MCD. All right, two pretty big companies. PLTR beat EPS estimates point 0.8, or its EPS estimates are point 0.8. Its revenue estimates are 602.80 million. They've beaten revenue expectations in 7 of the past 8 quarters and beat EPS estimates in 3 of those 5 same reports. So definitely something to keep in mind. Definitely a good company to keep an eye on. McDonald's, second largest restaurant chain by local total locations. Number 1, I think, is Subway. That could be old facts. Don't quote me on that. But yeah, they got a lot of locations. Uh, their EPS estimates are 2.83. Revenue estimates are 6.45 billion. They have missed EPS estimates only once in the past 8 quarters and revenue estimates twice. So definitely, McDonald's is always quoted as a good growth stock. Lots of people buy it because it's kind of one of those companies that they found their niche. Well, it's not really a niche, but they found their market. They hold quite a large chunk of the market share, and no one really sees it going anywhere. Though I do gotta say, I have noticed with the increase in prices now and things getting removed, like the dollar menu and such, a lot of people have pointed out that if you go and buy a meal at McDonald's, it's like the same price as if you go and get the ingredients to make the meals at home. If you spent the same amount of money, you could make like 2, 3 meals at home rather than getting one meal at McDonald's. But I digress. McDonald's is still one of those heavy hitters for a lot of growth investors. Also on Monday, we got Caterpillar, we got Tyson Foods, Chegg, lots of good companies to keep an eye out on for earnings. Tuesday, we have Ford. Ford is amazing. If we pull up Ford here, I bought Ford during like the COVID crash at like $4 a share and then sold them at like $20 a share. So yeah, if you look here, they dropped pretty heavy during the whole COVID crash here. And yeah, sold them up here 4 times my portfolio. They're one of those stocks I suggest to anyone who wants to buy a good company but has a small portfolio. They're only $12 a share. So I'd definitely suggest Ford if you're trying to build up a good portfolio but don't have a lot of capital to build that portfolio with. EPS estimates are 0.12, revenue estimates are 41.38 billion. They've missed EPS expectations in 4 of the past 8 quarters and came up short on revenue estimates 3 of those past 8 quarters. So definitely, again, like I said, good one if you have a small portfolio. On Tuesday, we also have Gilded Sciences, BP, Snap, Lumen Technologies, Dew Point. There's Eli Lilly that I was talking about, Chipotle, and Spotify, and tons more, obviously. But yeah, lots of good companies to keep an eye out on. Wednesday we have Alibaba and Disney, right? Definitely two heavy hitters coming out on Wednesday. So yeah, Alibaba, they don't really have estimates here. Not sure why. Likely just because it's a very volatile stock. But Disney EPS estimates are 104, and revenue estimates are 2379. They've topped EPS expectations in 5 of the past 8 quarters, while revenue has beaten estimates in 4 of those 8 quarters. And for a lot of people, they may look at that and wonder, why is Disney going so far down then over these couple of years? And honestly, it's just they haven't been making the decisions, the best decisions. This is interesting. I'm gonna have to look at that. Ramping up to be a magical year for Disney. That's interesting. But anyways, yeah, they haven't been making the best decisions when it comes to the movies and such. Kind of seems like they got caught in this like cookie cutter thing going on, right? Like they struck gold with the Marvel movies and like these other movies, like they're more child movies and things like that, and they're musicals. And then once they hit that gold, they kind of just said, "All right, we're going to use this cookie cutter formula and make all these other movies doing the same exact thing." And lots of people caught on and weren't too proud of it. So Disney's, I mean, honestly, they're still a great company. They just got to stop doing uh, the copy and paste that they're doing with a lot of their entertainment. Also, if I don't know how much you guys focus on Disney, but their parks haven't really been doing too well. Lots of people haven't been liking the changes they're making. Um, I didn't even know this, but apparently a while ago they even made it so bathrooms now have lines, and obviously they have lines, but you can skip the line if you buy a pass. So lots of people weren't too happy about that one. But yeah. So also reporting on Wednesday, you got Alibaba, PayPal, CVS, Omega Health, Roblox, Emerson, Yum Brands, Allstate, Mattel, lots of big brands coming out on Wednesday. And then Thursday we have Philip Morris International, big tobacco company. Um, EPS estimates are 1.45, revenue estimates are 901 billion, and they've beaten EPS expectations in 8 consecutive quarters, missing revenue estimates only twice in that span. So this is definitely a good company. That I mean, it's tobacco. You know, they're it's one of those markets where it's based on an addiction, and unfortunately, not too many people can get past that addiction. So it's a huge market with nearly permanent customers, right? Because once you get hooked, there is almost likely no going back. So um, yeah, Pinterest, Cloudflare, Under Armour, Take Two, S&P Global, Expedia, Spirit Airlines, Hershey's, Harley Davidson, lots of good companies coming out on Thursday. Friday we got PepsiCo. PepsiCo has been wild. Oof, man, they recovered quick from that pandemic and have just been killing it. Um, but yeah, so PepsiCo, um, EPS estimates are 1.72, revenue estimates are 28.38 billion. They've beaten EPS and revenue estimates in 8 consecutive quarters. Pretty wild stuff if you think about it. But yeah, they've been doing really good. Also reporting on Friday, WP Carey, Plains, All American, New Well brands, and more, obviously. But yeah. Overall, that's the look. That's how it's looking this coming week. Definitely some wild stuff going on. Still, a lot of these big companies coming out. As long as we keep getting good earnings and revenues, then definitely looking like it could be a good first quarter for the beginning of the year. So yeah. With that being said, if you guys have any questions or anything, let me know in the Discord chats. Send me a message. My messages are always open. Feel free to tag me in the chat too. I'll try to get back. I prefer you send me a message like in DMs, but if you don't feel comfortable, you can tag me in the chat too. I'll try and get back to you as soon as possible. And yeah, with that being said, let's make this money.